Right then, let's get going. Welcome to Kepler Insight latest webinar, where we're going to be covering the European gas crisis and the ramifications for the global LNG and coal markets. Just a quick introduction or a quick recap for people that may not have seen it. But if we could just move to the next slide, please. Recently, Kepler acquired JBC Energy. This JBC Energy has been in the independent commodities research space for the last couple of decades. It has a fantastic reputation within the industry for very robust modeling, forecasting, in-depth knowledge around the energy sector. We really feel that the addition of JBC Energy into Kepler and the integration into the Kepler Insight product is a fantastic fit. It really matches some of the expertise and understanding of the market that we have within Kepler with an equally solid understanding of JBC Energy. So this acquisition kind of really brings together the launch of Kepler Insight, which is a new front-end portal that we have within the Kepler terminal, where we're bringing together all of our research, our detailed balances, our editorial commentary, our forward-looking views, and analysis on the markets, and really benefits from the fact that it's plugged into all of the data, the commodity flows, the inventories, the freight information that we have coming across from the Kepler terminal and from the Kepler data products that many of you kind of know and use within your day-to-day business. So we'll get going with the webinar itself. Today we have 3 presenters, and I'll be coming back to moderate the Q&A at the end. So just say, if you have any questions, please put them into the Q&A box at the bottom of your Zoom window, and we will have time to go through these questions at the end of the session. So starting off, we have Laura Page, our senior LNG analyst based in the UK. She's going to be kicking off proceedings around what we're seeing in the LNG market, how they're developing. She'll be followed by Ryhana Rasidi, a gas and LNG analyst based in Singapore, with Matthew Boyle finishing off the session with how we're seeing things developing in the coal markets. And I was just talking to someone earlier today, if you thought, well, we were questioned as to why would we be looking at the coal markets a few years ago as we were pushing into that sector, and if it's more relevant today than it has been in the last couple of years, and not only from a switching point of view in Asia, but even talking about fuel switching in Europe because of the extenuating circumstances that we're in at the moment. So I'll leave you in the capable hands of the team, and hope you enjoy our webinar today.
Well, thank you, Alex, and a really warm welcome to everyone listening today. So yes, it's been a super interesting time in the gas markets recently. We're going to start off with looking at gas and LNG today. We'll spend some time reflecting on what has happened this winter, particularly focusing on Europe, and also take a look towards the year ahead and some things to watch out for. So today's presentation, I'm going to take a look at where we are looking on the global gas pricing front. We've really hit all-time record highs in Europe and Asia this winter, and prices remain really strong for this summer season as well. As we've discussed in our previous webinars and all of our written commentary at Kepler, this is a trend which started last summer when Europe really struggled to attract LNG due to strong demand from Asia, but also from South America as well. Going into winter, European gas storages were at very low levels for the time of year, Russian pipeline gas supplies became very erratic, and there were lots of uncertainties surrounding the approval of the new Nord Stream 2 pipeline. And all of these factors really combined to boost prices to a whole new level. And you can see at one point on the chart that the European TTF was trading at $70 per MMBTU. And that's really a stark turnaround from the lows that we saw of $2 per MMBTU in the summer of 2020. Now, since mid-December, the TTF has been the premium market for flexible spot LNG supplies. And you can see that Asia has really backed away from trying to compete with Europe. Demand has posted year-over-year declines in Asia this winter, and buyers have really been maximising their oil-linked contractual volumes, which, as you can see from the chart in the blue line, are at a much cheaper price than spot cargoes. Now, as we come out of the peak winter season, prices usually drop quite sharply in Europe and Asia, but they remain very elevated in Europe during the shoulder season. And that's largely due to nervousness about the volume of gas supplies that Europe is getting from Russia. So if we move to the next slide, why is Europe so nervous about this? Well, it's mainly due to their high dependency on Russia for gas supplies. So last year, Russian gas accounted for about 45% of EU imports, which is a really significant volume and accounts for approximately 155 BCM of gas. Now, certainly any large supply disruptions to major Russian gas consumers, such as Germany and Italy, would have really severe consequences, as the region is really trying urgently now to rebuild storage ahead of next winter. And Germany also doesn't have any LNG import terminals. Now, the region is really trying, to diversify away from Russian gas, but it's impossible to replace this volume with alternative supplies in the immediate term. And that's why we think that an embargo is looking quite unlikely in our view. We have, however, seen a very ambitious plan by the European Commission to try to replace around 2/3 of this supply by the end of the year. But that requires a really substantial increase in LNG imports, which is something that Ryhana is going to discuss later in the presentation. But when we're looking at Russian gas and how much is coming in, well, about 90% of that volume is coming in via pipeline. And you can see on the chart that arrivals have really been on a downward trajectory this winter. And this is a topic that we've been discussing extensively at Kepler. So far this year, Russian gas volumes through the 3 key pipelines have come in about 31% lower year on year. And this is what's really squeezing supply into Europe and driving those prices higher. Now, in the immediate aftermath of the invasion of Ukraine in late February, pipeline supplies did continue even through Ukraine, but there have been quite a lot of volatility in supplies due to buyers flexing up and down on their Russian contractual take. So many Russian contracts are linked to the TTF in the previous month or the previous quarter. So sometimes it's made sense to buy more Russian gas, and other times it's been cheaper to buy from the spot market instead. But over the last couple of weeks, Russian pipeline supplies are seeming a lot less secure. As I'll explain in the next slide, the Kremlin is asking for Russian gas to be paid in rubles, and that's already seen Russia and Bulgaria cut off from supplies due to non-compliance. We also had energy company Gazprom come out yesterday and say there is a real risk that gas supplies could be cut off to Finland as well this week. Then last week, the Ukrainian TSO declared force majeure on one of 2 entry points for Russian gas due to interference from the Russian forces. And Moscow also sanctioned 31 Gazprom entities, which is affecting about 3% of Germany's imports from Russia. So certainly things are heating up in the market. So at the end of March, Gazprom announced that unfriendly countries would have to pay for Russian gas in rubles. And this was essentially designed to try to prop up the Russian economy. Essentially, this meant that buyers of Russian gas had to open up euro or US dollar and ruble accounts with Gazprom Bank. The buyers would deposit the payment into the euro or US dollar account, and then Gazprom Bank would convert into rubles, which would complete the payment. Now, Europe is very divided on this, and as I said, Poland and Bulgaria both got cut off at the end of April. Poland has a 10.2 BCM per year contract with Gazprom, and Bulgaria a 2.9 BCM contract. But both of these were due to expire at the end of the year and were not expected to be renewed. So we did expect Russian gas volumes into these countries to end, but this has just come 8 months ahead of time. So thankfully, both of these countries have been seeking alternative routes over the past couple of years, and you know, the number of sources of supply will grow as the year progresses. So just looking at Poland, Poland has its own LNG import terminal. This month, they gained access to the Lithuanian LNG import terminal too through a new pipeline connection. They're also importing spot gas via the Yamal pipeline, which is operating in an eastwards direction from Germany into Poland. And they have about 3 BCM of gas in storage. So that's probably enough to get them through. At least until October, when the 10 BCM per year Baltic pipeline from Norway will come online, and that will mean that Poland can fully displace Russian gas. For Bulgaria, they have access to LNG import terminals in Greece and Turkey. They also receive gas from Azerbaijan via the TAP pipeline and an existing connection between Greece and Bulgaria. The pipeline capacity between Greece and Bulgaria is quite limited though, but that should be alleviated hopefully next month when a 3 BCM per year IGB pipeline will come online between the two countries, which will basically expand capacity there. But there are, of course, other countries in Europe which are more heavily reliant on Russian gas, such as Germany. And they need to keep the gas flowing. We've seen that some of the larger buyers, such as Italy's Eni and Germany's Uniper, have come out and said that they will comply with Moscow's demands. But it's not very clear what the level of compliance will be on a whole, because there's still some quite mixed messages coming out from the European Commission about whether opening a ruble bank account breaches sanctions. So this is certainly something we need to watch out for over the coming weeks. Next slide. So just moving away from pipeline gas and looking at the LNG side, we have been using our in-house export data to monitor supply from Russia's 3 operational liquefaction plants. You can see on the chart on the left that there have been no disruptions so far. Daily moving averages are certainly holding up. In fact, when we look on a year-over-year basis, Russian exports of LNG are rising, and they've increased about 10% year-over-year so far between January and April. On the right-hand side, just looking at the destinations of cargoes, well, 49% of Russian LNG is still being shipped to Europe as of April, which is unchanged from a year ago. But there are some quite stark country differences. So the UK announced a ban on Russian-linked vessels from entering UK ports in early March. So we are now seeing no Russian LNG heading to the UK now. It does look like there is more inflows into France, Netherlands and Belgium to make up for that, And you can also see that imports are rising into China as well. Next slide. So looking ahead to this year and things we need to watch out for, of course, Russian pipeline and LNG supplies will be crucial, but we also need to keep an eye out on the injections into European gas storages. So gas stocks ended last winter at around 25% full, which you can see from the chart is well below the 5-year average. The European Commission is due soon to implement a requirement for every European member state to hit 80% storage fill by the 1st of November this year. And that's essentially to ensure gas supplies for next winter. But for this to happen, they need to inject around 41 BCM of gas between now and that date. So you can see that the rebuild chart rates are doing very well so far this summer season. And if the average rate for May continues, we would expect to actually hit the 80% mark by August. But this requires LNG imports to remain very strong and no major disruptions to Russian gas supplies. Next chart. So in the next slide, you can see just how well European LNG imports have been performing. And this is a trend which started late last year when Europe, the TTF, became the premium market for flexible spot supplies. So far this year, Asia has really been stepping back from the market, in particular China, due to the high spot prices, the COVID lockdowns, and stronger domestic gas production as well. Japan has greatly reduced their LNG imports due in part to very strong nuclear production during the winter. And we've had price-sensitive India also stay away from the spot market. And this is all essentially leaving more LNG supply for Europe. You can see that France, Belgium, and the Netherlands have really pushed their import capacity and are trying to fit in as many cargoes as possible. And this really chimes with what we're hearing from the market, that there is limited regasification slots left on the prompt. All of this is really justifying the need for more import capacity. And we've seen lots of proposals come out for new facilities over the past few months. We think around 10 to 11 MTPA of new capacity could come online by the end of this year. And that includes a first LNG import terminal in Germany as well. Elsewhere in Europe, UK imports are very strong, and that's weighing on the MBP versus the TTF, really due to limited capacity to get that gas over to continental Europe. And you can see that Italian imports are ticking up as well. Italy is a major consumer of Russian gas as well. Now, the only key area where Europe could take in more LNG is Spain, but the ability to transport that gas to the rest of Europe is very challenging given limited capacity on the Perennius pipeline, which passes from Spain into France. And because of that, we're seeing discussions resume to restart construction of the half-completed Mid-Cut pipeline between the two countries. So when we look at where this additional LNG is coming from, the US has by far added the most incremental LNG supply to Europe. So I'll pass the word on to Ryhana, who will explain more and also provide some forecasts for the rest of the year. Thank you.
Great, thanks, Laura. So next slide. Picking up from that point, we are seeing the US delivering more of its LNG to Europe. And if you look at total volume so far from the US to the region, they are currently close to 27 million tons since the start of the year up until April, which is more than 7.3 million tons that we see in the same period last year. But aside from speaking in absolute terms, the actual share of US exports to Europe has also increased quite dramatically. So since the start of the year, the monthly share of US LNG to Europe has in fact been consistently above 70%, which is the highest it's ever been, especially when previously it's only reached as much as 65% back in February 2020. And so right now, with the big increase in European LNG demand ever since the Russian invasion, US exporters have reacted quite swiftly by ramping up their production to nearly full, or in some cases, above nameplate capacity, except for maybe when there's maintenance, like we've recently seen at the Freeport and Cameron facilities. But still, generally, from a financial perspective, the strong LNG prices are encouraging exporters to keep production levels fairly high. Another thing to note is that the US is a big supplier in the LNG spot market, unlike, say, Qatar, which has instead most of its LNG supply locked up in long-term contracts. So what this means for the US is that its exporters can easily respond to changes in demand, which is why in the past you could see some sort of seasonality in the regions where the US ships its cargoes to, mostly because they were reacting to where prices were higher. So now with TTF prices above JKM, that's why we're hearing more about the US diverting its cargoes from Asia to Europe compared to other exporting countries that have much less freedom since they mostly have to fulfill their contracts first. Now, where do we see US LNG for the rest of the year? Well, that depends on different factors, but for a start, it's worth pointing out that no new US liquefaction facilities are expected to come online until 2024, which means that as long as prices stay high going forward, we'd expect that US producers will still keep producing as much as they can, or at least at the current levels that we're seeing. And based on this assumption, we are estimating annual US LNG exports to reach 81 million tons this year, which is up from around 70 million tons in 2021. However, there is a potential for this forecast to be lower if unplanned outages take place, especially during the hurricane season, which usually happens between June and November. And that could sometimes come with disruptions to supply, either directly in terms of actual production, or if weather conditions are just so poor in the Gulf Coast that it affects shipping as well. In terms of figuring how much supply will go to Europe, we typically look at forward netback prices, which gives some sort of indication of how much a producer can expect to earn from exporting a single cargo to a particular destination after subtracting voyage costs and other fees. So looking at our chart here, we've presented the netback prices for Northwest Europe in the dark green line, which is above the lighter green one that represents Northeast Asia. And if we are interpreting this, we're basically expecting that US exporters will be able to earn more from delivering their cargoes to Europe than to Asia for the rest of the year, which would suggest that Europe will likely still be able to take in a larger portion of US supplies until the end of the year. Now, if you look at the next slide, the overall supply picture, how much LNG can we expect to be produced globally this year, and will this be enough for Europe? Before we can jump into the first question, and touching a bit on a point earlier, we have to bear in mind that unplanned outages do occur at various points throughout the year, which is why on the chart here, you'll see that annual LNG export levels in the past, shown in the dark blue bars, rarely reach the actual production capacity level, which is the green line. And that's quite simply because potential supply gets lost due to scheduled maintenance, operational issues, or random outages that may occur during those periods. Anyway, if we look at this year, we are expecting 18.7 million tons per annum of liquefaction capacity being added, 10 of which has already come online this year from the Calcasieu Pass facility in the US. And all that remains are new terminals that will come online in Mozambique, Russia, and Indonesia. If you put a rough timeline to this, we are expecting Mozambique's Coral Sul floating facility to be commissioned in the second half of the year, which, as a fun fact, would make the country an official LNG exporter for the first time. We then have Russia's Portovaya LNG terminal that should also come online after being delayed since 2019. And then we have Indonesia's Tango expansion being completed more towards the end of the year. So given this increase in capacity, we're obviously seeing room for energy supply to grow year on year, which are forecast to reach 434 million tons. And this is generally assuming that most existing terminals will continue to operate more or less at their average utilization rate, but with some producers like the US clearly responding to the high price environment by supplying more to the market. There's also some good news for Europe as Norway's Hammerfest LNG is returning online after being shut down by a fire back in September 2020. So this would definitely be something positive in terms of providing the region with a few extra tons of LNG. But before I can confidently say whether this is all enough supply for Europe, we must consider how strong will competition be for cargoes this year. So if we switch over to the next slide, we'll just take a look at where we're expecting Northeast Asian LNG demand to be this year, since the region is usually Europe's biggest rival in terms of LNG imports. Now, it's interesting to highlight that assuming an average summer, we are expecting Northeast Asian LNG demand to fall by about 2% annually to 216 million tons this year, which is quite a dramatic change from what we would have expected before the invasion. That is, LNG demand growth will still be positive, but maybe slightly lower than the previous year because of higher spot prices. But as Laura mentioned, given the current pandemic lockdowns in China, which have affected industrial activity, and the fact that the country's domestic gas production hit record highs in March, that is adding another layer to why we are expecting LNG demand to be much weaker this year. Meanwhile, we're also probably likely to see more of China's LNG demand being substituted with higher Russian pipeline imports via the Power of Siberia, which Gazprom has said it's already 60% higher between January and April this year versus the same period last year. Also, as you can see from the chart, South Korean LNG demand is expected to be slightly lower this year due to increased switching to alternative fuels like nuclear power. We'll probably see this gas to nuclear switching less so the case for Japan, since nuclear power is forecast to still be lower year on year, which is why we're forecasting a slightly smaller decline in its demand to reflect that LNG imports may stay relatively supported. Lastly, for Taiwan, LNG demand is expected to remain quite flat year on year, since we haven't really seen much downside in its imports despite what's happening in the rest of Northeast Asia. And that's most likely more related to the fact that Taiwan's electricity is heavily subsidized. So it's likely that consumers haven't felt much of the pinch of the higher prices, but that does leave us with the question of whether it's sustainable. So with Northeast Asian demand covered, and if we go to the next slide, we can probably build a clearer picture of energy supplies to Europe. And based on the figures that we shared earlier, it would seem that there's about 218 million tons of LNG left available for Europe to import this year. Of course, we're not expecting this to be the total amount that Europe does import, since we haven't really discussed LNG demand in other regions. But if we account for those two, we're still estimating that available supply to Europe will still be above its regasification capacity. Even so, we don't necessarily see Europe needing to import for the entire surplus capacity it has if restocking efforts remain on track for inventories to meet their targets by the start of November. And with that said, we are expecting total European LNG imports to reach 106 million tons this year, which in BCM terms is almost 58 BCM higher year on year, and that should satisfy the EU's current plans to replace at least 50 BCM of Russian gas by the end of 2002. There are also further plans to replace at least 34 BCM of Russian gas with renewables and energy saving measures, though that's probably more to keep demand in check so that Europe can maximize its gas injections or at least minimize withdrawals from storage. To be honest, we'd say that the more concerning issue is probably that pipeline connectors between the EU countries are currently lacking, which is quite important if you want to distribute enough LNG across the region, especially to places that do not have their own regasification terminals. And of course, as Laura said earlier in the presentation, there are already plans to get the necessary infrastructure built, and it's something that we should keep our eyes on in the coming months to see if the region has made any improvements on this front. So now that we've gone through our LNG outlook for this year, I'll pass it over to Matt Boyle to talk about the effects we're also seeing in the coal market at the moment and going forward.
Thanks, Ryhana, and hello all. So it's actually been quite nice to sort of hear the discussion on gas and LNG, because there are a lot of similarities, I guess, between those markets and also the thermal coal markets, particularly at the moment. As Alex was alluding to at the start of the webinar, there's tightness in supply, and that's been exacerbated by the Russia-Ukraine conflict. And import demand is continuing, especially in Europe, as coal remains priced into the generation stack. But the question I guess I want to sort of try to answer is, like, is this demand just a function of the supply dynamics, or is it something that is growing and will continue to grow across a number of global markets as we sort of head through the summer period and into the Q4 winter period in the Northern Hemisphere? I've been attending a couple of events in Singapore, Iron Ore Week, or Ferris Week, I think it's now called. And you know that the thermal coal and the gas market is quite important when, even at a iron ore event, they're asking you questions on thermal coal and gas. So it seems rather timely that we should sort of discuss it in this webinar. Of course, Kepler Insight does actually provide research and analysis on the metallurgical coal market. So please do reach out if you would like some more information on that. So I want to talk a little bit about the Russia-Ukraine conflict, because it is sort of rather dominant in the market. So if I look back at history, Russia has been increasing its thermal coal exports steadily over the last couple of years, in particular to its natural destination market, which is Europe, as well as its growing markets in Asia. It is actually quite remarkable that there was a push in Russian coal exports during February, which aligns with the start of the conflict. And so that shows up in our Kepler data for March, because this chart is actually showing the arrivals into Europe, China, and India. However, if I was to extrapolate this chart and take April and the first half of May data, it would show the imposition of the economic sanctions has dramatically slowed Russian thermal coal exports. Now, part of this is somewhat demand related. You can see so the middle line, the orange line there, showing China. Chinese import demand had fallen quite considerably as domestic coal production has increased. We also had the Beijing Winter Olympics and COVID lockdowns, which has sort of impacted demand from industry as well as power generation. However, the economic sanctions will also play a factor in the ability for the key spot thermal coal import demand markets to take advantage of potentially taking Russian coal. So while I think that every spot import market would be willing to take discounted coal, especially given that spot coal prices are 4 times the level that they would usually be, it is somewhat questionable whether these buyers can purchase this coal in rubles or through Russian bank accounts. As Laura was sort of referring to in her presentation, the ability to actually financially transact that trade is problematic. And so that's completely disregarding the impact or the potential political ramifications that sort of purchasing coal in a sanctioned environment could do. So what then would the challenges be, if I switch over to the next slide there, for buyers that might have been reliant on Russian coal? So where can they make up this shortfall? before I sort of get into that, I want to sort of talk a little bit about some of the structural issues in the seaborne thermal coal market. Some of this is related to the pandemic, but as well as general financing reasons. So during the pandemic, demand dropped sharply and producers ended up adjusting their production to market expectations in order to better match that demand. So this saw coal producers prioritize output for longer term customers. So this then had a knock-on effect on the spot market and saw spot coal availability dry up and become more scarce. So as the market started slowly emerging from the pandemic, import demand in Southeast Asia, Europe and China and India started to pick up. These markets are more spot coal markets, although Europe does have a good mix of longer term contracts as well. The coal producers did not increase production to take advantage of the higher spot prices. And we at Kepler Insight believe there are two reasons for this. So the first is it has become harder to raise finance for brownfield expansions or greenfield projects, rehiring a labour force, as a lot of the financial institutions have pledged or actually have stopped coal industry financing. The second point, and this is what we believe is aligned with our forecast, is demand itself has not picked up back to pre-COVID levels. And I'll talk a little bit more about this shortly. So if we consider this, where can these additional volumes come from? You need to remember that Russian coal is high energy coal predominantly. So the majority of Indonesian coal could not replace this coal into Europe because Indonesian coal is a low energy coal. We do have idled capacity in South Africa and Colombia, but there are inherent issues here as well as logistics and the sort of having to reopen shuttered mines. Mozambique could provide additional thermal coal volumes into Europe, so we may see a little bit of a bump here. Australian coal could flow to Europe, but this would be dependent upon favourable backhaul freight routes and arbitrage opportunities. So I guess the key takeaway here is that while there will be some additional supply coming into the market, it is more likely this shortfall will not be met by increases from elsewhere. So if we then turn, after looking at supply, and let's have a look at demand. As I mentioned, we've seen demand improve from the pandemic lows in 2020 and the first half of 2021. However, we question whether demand has really returned to pre-COVID pandemic levels. And we believe there are a couple of factors at play here. First, domestic coal production in two of the largest import demand markets has improved year on year. So this has displaced the need for imported coal to meet this demand. Second, overall coal-fired generation since the start of 2022 has been flat, albeit at high levels. We have seen increased renewable generation across India and China, and that has helped alleviate the pressure in the thermal gap or on coal plants to supply power. Now, I know that this is not a narrative that would sell papers, especially when you have weather-related demand spikes in India over the past month or so. But the fact remains there is some seasonality in both Indian and Chinese thermal power generation, which makes the dire need for coal imports less important. So it's not as, maybe the weather has magnified the fact that we've seen an uptick in power generation over the last month, particularly in India. So just quickly, actually speaking of India, the low utility stockpiles at coal-fired power plants have been around about that 8 days of stock level since October 2021. So that's important to keep in mind because given the impending monsoon season, it's probably unlikely that they would need additional coal imports despite the pleas of India's Ministry of Power over the past couple of weeks and even overnight. So at the crux of it all, the final factor really comes down to cost. The stronger US dollar is making coal imports more expensive on local currency terms. And in the case of India, I'm not hearing of any subsidies to help utilities cover the high spot import price. So the economic rationale is just not there. All of these factors are bearish for demand over the second half of this year. So if the seaborne coal market, the thermal coal market, is sort of in a game of coal market chicken, I guess. And so for those that don't know the game of chicken, it's sort of like a staring competition where the first one to blink, or in this case, act, loses. So I've spoken about the numerous challenges the seaborne thermal coal market has faced. You've got the pandemic and weather-related demand spikes and the inability to increase production for a number of reasons, as well as inflation and the high US dollar. So all of these factors have combined to boost spot prices. And note on this chart in particular, for May and June, they are Kepler Insight forecasts for both the exports as well as the prices. So in order to increase spot import demand, it needs to be economically viable for buying to pick up. And limited supply has sort of seen spot prices spike to record levels, as in particular after the Russian-Ukraine conflict began. So Indonesian and Australian thermal coal exports are around the 2019 levels. So you could argue they are back at pre-pandemic levels. However, in the case of Australia in particular, this is more due to long-term supply contracts. And again, that producers matching that production to market expectations. Indonesia is the swing supplier, as they are more spot focused. And so our export forecast is bearish due to the high spot prices, sort of causing import demand destruction. So back to the game of chicken, who blinks first? In our opinion, we believe current spot prices are not supported by fundamentals at their high current levels. So we believe prices will have to fall back to a level where it starts to encourage buying and imports again. So in summary, the slowdown in Russian coal exports will result in a large chunk of supply removed from the market. Indonesian exports will be lower due to the high spot prices, causing import demand destruction, especially when looking at demand. Chinese seaborne imports are likely to be lower year on year. You have to remember that they hit a record high in 2021. And with the increased domestic coal production at a cost lower than seaborne coal, it disincentivizes the ability to purchase seaborne coal, unless that ARB improves, that import ARB arbitrage opportunity improves. It's not all doom and gloom for imports demand. There are increases in Northeast Asia and India, but overall for the seaborne market that was relatively balanced as we moved into 2022, producers would need to adjust production expectations further to meet this demand, be it supplying more into the spot market, or finding long-term contract customers to sort of take that coal. And so on that note, I think we're ready for Q&A. So I will pass it back to Alex to let us know what questions have come through.
Brilliant. Thanks, Matt, and thanks for the rest of the team there. So we'll actually stay on coal and then jump back into gas. You mentioned earlier that it would be difficult because of the qualities of the coal involved for European power gen companies to use Indonesian coal. Do you think that is feasible at all to kind of supply more volumes, more tonnage into the market in the region, or is it just too different compared to what they're used to processing?
Yeah, good question. I guess technically they can take it, but whether or not it's economically viable for them to do it, that is probably the key. So we have actually seen Indonesian coal flow into Europe. A lot of those coal volumes are actually of a high CV coal, so it's a higher energy coal. They have taken some of the Spanish and Italian power utilities have taken a mid-energy coal to try and sort of use that, and to blend with US coal or maybe even Colombian coal. The key point, I guess, is probably more to do with the boilers are not really designed to take a lower energy coal. So, plus you got the freight component. So it may be cheaper on an FOB basis to get the Indonesian coal, but on an energy adjusted basis and a delivered basis into Europe, it may not be economically viable. So those coal flows will probably be more opportunistic in our opinion.
Brilliant, thanks, Matt. So moving back to Laura then, looking on some questions around LNG and gas. You had that chart showing a projection for where the European Union wants to be in terms of storage levels going into the winter. And the question is, in Germany and EU, a lot of the storage capacity is actually held still under Russian companies. How do you see that working out? Like, are there alternatives? How does this happen, given the complexities of the situation?
Yeah, so yeah, you're right. Gazprom has a number of storage sites, many of which are located in Germany, which of course is very reliant on Russian gas, as I said. We had news recently that the German government has actually nationalized Gazprom Germania, which has a number of subsidiaries that actually operate those large storage sites in Germany. And that includes Redden, which is Germany's biggest storage site as well. And that was essentially designed to ensure security of supplies. So those are now not being operated by Germany, by Gazprom, sorry, and they are under kind of German government rule. So hopefully that allows them to be rebuilt, because obviously last summer we didn't have gas storage being rebuilt in those storage sites as strongly as the others. When it comes to alternative sources of supply, certainly LNG is crucial at the moment. This is what's adding a lot of gas supplies to Europe. We also think that Norway could increase gas supplies this summer versus last summer, and there's also opportunities for Azerbaijan through the TAP pipeline and potentially through Algeria as well. So there certainly are other sources of supply, but LNG is crucial.
And then staying in the region on the LNG, you showed a chart earlier that showed the differentiation or the change in import levels, even of Russian gas within the region as well. So kind of Europe dropping, France increasing. Could you go into a bit more detail about, or kind of explain again, sorry, why we're seeing that happening?
Yeah, for sure. So yeah, as I said, on a percentage basis, the volumes are exactly the same as they were last year. So around 49% of Russian LNG is still going to Europe as of April, and that's unchanged from last year. UK is now not importing any Russian LNG. So we had news out in early March that any Russian chartered, Russian owned or Russian linked vessels are now not allowed in UK ports. So since then, we haven't seen any Russian LNG coming into the UK, and the UK is replacing that LNG with alternative supplies from the Atlantic basin. So we're seeing, more Qatari gas, Trinidad, Nigeria, Angolan gas going into the UK, for example. But when we look at other countries importing Russian LNG, certainly Northwest Europe is taking more, as in Northwest Europe, continental Europe. So France is taking a lot more Russian LNG, potentially those cargoes that could have gone to the UK. It's very hard to say, but the increases are quite stark. And we're also seeing more into the Netherlands and Belgium. But remember that overall volumes have gone up as well. Yamal brought online train 4 last summer, so that's adding to supplies.
Brilliant, thanks, Laura. And so, following on from that with a question for Ryhana, if we're assuming that Russian flows can continue and that we do hit that 80% plus level or so by the time we're getting into the winter, kind of by the time we get to autumn, how do you see, is there a risk that we see a real crash in LNG prices or gas prices as a whole in the autumn and going into the winter? Do you think that's feasible?
So yeah, good question. We don't really see prices likely to fall so much when we say like Russian flows continue and Europe meets their storage targets, because we have to bear in mind that at the start of the year, Asia has sort of been holding off from their restocking, and now if Europe does meet their targets, that's probably the chance for Asia to really sweep in and take all the extra supply there is in the market, and that's most likely to keep prices elevated so that they could focus on their own restocking going forward. And yeah, so we've seen that Japan has also held off their restocking, and that's probably going to be a chance for them to restock go into winter. Yeah.
Excellent, thank you. And we've just got time for one last question, but I'm afraid we haven't been able to get through them all, but we can see if we can squeeze another one. There's a question here. This is for Laura. Europe has traditionally become a market that's very spot cargo dominated, with a real hesitancy to push into long-term contracts for LNG. Is this something that you could see changing? Do you think the long-term agreements are looking to be signed up by US producers and is going to be able to flow through? How do you see that developing?
Yeah, certainly it is a potential. I mean, supplies are very limited and there's really strong competition between Europe and Asia. So we saw that last summer, Asia was certainly sweeping up most of those spot cargoes, and some of them were going to South America as well. And Europe essentially couldn't compete because Asian demand was so strong, they just kept bidding up. So that could really hamper Europe's ability to increase LNG imports if that happens in the future. So, you know, it is certainly a possibility that you could see European LNG importers signing long-term contracts to basically ensure that security of supply, because at the moment it's all very reliant on what is happening globally with LNG supply, but more importantly, what is happening with Asian demand. It's fine at the moment because Asia has been stepping back from the market, but there is a chance that they could come back, you know, into the market, as Ryhana says, to restock, and that would draw cargoes away from Europe.
Excellent, thanks. So let's just do one last question and we'll give it back to Matt so we can have a look at something on the coal side. Just to finish off with, so there's a question around actually the Chinese production of coal that has just been, the ramp up has been phenomenal in recent times. And how do you square off the kind of this huge increase in domestic coal production versus, as I think we were mentioning earlier, the decrease in domestic demand in the country?
Yeah. So the Chinese thermal coal import market is predominantly a price-driven market. So if the cost of seaborne imported coal is cheaper than domestically produced coal, then it encourages imports. Now, you have to remember that China has an import quota of about 300 million tonnes per year, of which it has to share that with met coal. So if met coal imports are 100 million tonnes a year, that means that thermal coal are 200 million tonnes or so. So last year, met coal imports were around 50 odd million tonnes. So that meant it was 250 million tonnes or so, or even more, of thermal coal imports that went in. So Given the circumstances of tight supply and underperforming renewables generation in August and October last year in China, the NDRC decided to crack down and sort of ensure that certainty of supply. So what they did was they pretty much forced all the coal producers to ramp up supply. Now, this has also seen an increase in safety inspections and that as well. But I mean, that has alleviated supply concerns or constraints in the domestic market to the point where utilities, we believe, because it's not as transparent anymore, we believe are relatively well stocked from domestically sourced coal. So this coal that China was usually taking on imports was coming from Indonesia. So Indonesia then needs to find a new market for it. They have managed to find that in India and in some other places. So, but the point is the average energy content for Indonesian coal, it's not really an API 2 spec in general. I'm making a rather big generalization here. I could sort of talk in more detail, and maybe I can sort of follow up more on this offline for whoever asked the question. But that is, in a nutshell, sort of where it stands for China.
Brilliant, thanks, Matt. Well, thank you for all of your questions today. Unfortunately, we don't have time to go through them all. There's probably another 5 questions there that we could spend a lot of time running through. Thank you for joining us. Just a reminder that we are also running an oil focus, so a crude and products focus webinar next week, which you are welcome to register for if you haven't already done so. We've sent mails out, etc. So please register and join that session. We look forward to speaking to you again in the future, and have a good day, everyone. Thank you very much.